Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to JP Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice. This week, the podcast is a little shorter than normal because both I and, more importantly, my producer Ben are away in Holland this weekend. Not, as you might think, in order to escape the sound and fury of the general election campaign. Who wouldn't miss that for the world? But for family reasons. As a result, this is an abbreviated edition with only one guest and without my normal summary of the main market and sector news headlines. You can, of course, catch up with all the latest news as a subscriber to the Moneymakers Circle. Our weekly email, with its usual mix of news, data and commentary, will be going out as normal at the weekend, along with our latest in-depth trust profile, which this week features CT Private Equity, ticker CTPE. Fortunately, also, I'm sure actually, that you will find the conversation that follows with the chairman of HgCapital of interest. We discuss the challenges that have faced the private equity industry over the last 3 years, and how and why HgCapital, not having been immune from a sharp derating itself, though that's an unusual event given its exceptional long-term record, has succeeded in returning to a small discount, while many other listed private equity trusts have failed to do so. The podcast will be back to normal next week for what I think will be episode 214. So this week I had a chance to talk to Jim Strang, who is the chairman of HgCapital, and if I can say so, I think a veteran of the private equity industry, been involved for well over 20 years, and has a track record, teaches private equity at London Business School, as well as being an advisor to some very prominent participants in the industry, including Bain and CVC. So it's very good to have you on the podcast. Can I kick off by saying, how would you characterize the experience of the private equity sector or industry over the last couple of years? It's been quite a tough period for private equity. I think everybody knows that. We'll come on to how well HgCapital have done through that period in a moment. But how would you characterize what's happened?
Sure. Thank you for having me on. I think last couple of years have been challenging. The combination of the geopolitical environment being very disruptive, rapid rises in inflation, the fastest rise in interest rate environment in living memory, if not ever, I can't remember which. All of that is definitely throwing spanners in the works, so to speak. And also you had the effect of 2021 was a blowout year. So effectively you're recovering from what was a very outlier year in terms of things all happening in the good way. And it's been a tougher environment. And that's been tough for everything. So tough for the investing environment, which turns into the exit environment to return liquidity. Tough for these, because private equity is effectively the funding structure, limited partnership. So these things are vehicles that are raised every 3 or 4 years from institutional investors for the most part. And they, as the institutional investors see less liquidity, then they're not so keen to support new structures because they haven't got the capital to recycle. So that's had a slowdown. So the combination of those different effects have made things quite challenging. The interesting thing is the portfolio companies themselves underlying have actually been very resilient. So the companies themselves have stood up to the challenges that the world's thrown at them pretty well. But the machine of private equity has slipped down a gear, maybe even 2 gears from where it was in 2021.
Well, you say it's a combination of factors. Rising interest rates would be part of that, being a consequence of rising inflation and also the shock we had with the Ukraine war. But private equity has been through this kind of experience before. How does this downturn compare to the one that you experienced in the global financial crisis?
In some ways it's similar, in other ways it's very different. So if you look at the impact on high-level deal activity, it looks quite similar. So the slowdown in deal and new deal activity and exit activity is actually not too different to what it was in the GFC. But the underlying macro looks very different. Because if you remember in the GFC time, 15, 16 years ago, things were horrible. And actually now, the levels of sort of underlying economic activity aren't so bad. And that, I think, is what you're seeing. So in terms of portfolio companies and the way they're performing, they're reflecting that. So that's the distinction. So the deal markets have definitely seen a bit of a whack, which doesn't look miles off what happened in the GFC, but the portfolio companies have actually been pretty resilient so far.
Why do you think that is? In the sense that if you look at the public markets, obviously we've seen a very dramatic fall in share prices and subsequently a recovery. And there's a lot of conversation about whether or not that should be read across into the private equity world. But is there actually a difference in the performance of the portfolio companies in private equity versus the performance of those companies in listed markets? Can we make any generalizations about that?
Let me give you some observations and you can draw your own conclusions. For the most part, private equity tries to buy market-leading businesses somewhere. They're not buying the weak number 5 player in any market. They're trying to buy into the top businesses' leading market positions. And then they are increasingly trying to use the same tools to generate profitable growth. So they have great private equity firms, HG, others have toolkits that they use to help companies achieve their full potential or to improve their performance towards their full potential. And they normally look to follow the pattern recognition of what they've done in the past. So if you like, in private equity of 20 years ago, it was much more eclectic, HG included, much more eclectic in what it did. And what's happened over time is they've realized that the way to optimize the outcomes and eliminate the bad outcomes is to focus more and more on particular areas where you can build all this knowledge and experience. And that becomes a bit of a virtuous circle, a flywheel. And so effectively what you're doing is you're saying, we're not looking through a massive aperture. We're looking through quite a narrow aperture in the kinds of businesses they want to own. They have these characteristics, which are market leadership type positions is a sort of a very normal table stakes for what they would look for. And then they're looking to apply a set of tools and capabilities to help these businesses reach their full potential. And then in addition, they're looking to improve those market positions. So one of the things that you learn at Bain & Company and when you're a consultant is that relative market share drives profitability. So how big you are relative to everybody else is a leading indicator of what your profitability outcomes are going to be. So if you can buy a business which has a strong market position and then improve it further by consolidating a market, then you're going to improve its relative market position, which will improve its profitability. And that's a tool and a playbook that's sort of well understood in the private land. Now, I mean, I used to be a public market fund manager a long, long time ago. And I'd say it's a sort of a different experience there. The other thing is when private equity gets involved in a business, it controls it. So, something north of 90% of the equity is held by one institution with one set of board governance. So their ability to drive change, understand what's happening and change the outcomes if they need to, looks very different. I used to be a small cap fund manager and a really big position for us was 5%. And our ability to influence the outcomes was 0. So effectively there, you're much more beholden on the company and whatever it is they're doing. And you don't have the same tools at your disposal. So it should look different because it is very different. That's the takeaway from all. And I'm guessing a little bit, but I would suspect the data would probably support that private equity's got a better fundamental record. I'm sure people would disagree with that, but that feels, certainly from my experience, that seems to be it. And even going back to HG, I mean, our portfolio is compounding up at something north of 25% EBITDA growth every year. And roughly half of that is just pure organic EBITDA growth. And I don't know what the profitability growth of the FTSE would be, but it's not 25%.
That's for sure. We've seen a lot of people talking about the shift from public to private markets in the recent years. We have seen some de-equitization as far as the listed markets are concerned. Is that set to continue in a higher interest rate world? And do you think that just underlines the point that private equity is a superior way to invest in profitable businesses?
I would say that the trend seems well established, that it's going to continue to grow and take relative share. And I suppose at its simplest level, the why is because in terms of who the customers are for private equity, and that is the investors, their needs are being exceeded. So if you have any market where the existing customer base's needs are being exceeded, then the chances of those existing customers allocating more capital to that solution or new customers joining that marketplace are very high. Basically, if you're doing more than you're asking me to do, then am I likely to do more or less with you? I'm going to do more. And even with the growth of the private market, so it's the private markets, which is not just private equity, but you add in the other private strategies that are ancillary to it. Say it's $14 trillion, which sounds like a massive number. Public bond and equity is 200 and something trillion. So despite all the growth, we're still somewhere in the single digits as a percentage. And if you ask the customers, and some of the work I do with Bain is around this, ask them what their aspirations are, then it's definitely higher. So, the sort of general consensus on private markets, if you ask Bain, McKinsey, Goldman Sachs, you name it, is over a several year view from here, it probably doubles. And if you ask Christian Sinding, who's the CEO of EQT, one of the biggest listed firms, And he's on record as saying his objective is to double, then double again. So I think there's a lot of inertia behind it. And the interest rate environment, I mean, private equity works in quite a lot of different environments. Just the thing that it has to manage is the transition. So if you basically say in today's market, its cost of leverage is 7% or 8%, whatever you pick the number to be, can you work with that? Yeah, because we worked with that before. You can work with that. The only thing that's challenging is if you set expectations around a different interest rate environment and it's now radically shifted, then you have to pedal a lot harder to achieve the goals that you set out from the business's perspective to be able to get to the same endpoint. And that's where we are right now. We're in pedal harder mode. And pedal harder normally means actually not so much pedal harder, but pedal longer. And that's what you're seeing, right? And this is what happened in the GFC. So the worst ever vintage year in terms of annual year for private equity performance was the GFC year. And I remember from my house lean days, that vintage of private equity investments did about 8 or 9%. So in the last 25 years, in any single year, there's never been a year below zero. And the worst year was 8 or 9. And the median is about 14.
So if there is all this demand out there, though, from people, and growing demand, particularly from institutional investors and so on for private equity, is there enough supply to meet it? You mentioned the fact that in overall terms, it's still quite a small percentage of the market. But are there enough first and second performing companies out there to actually satisfy the demand from all these things? Or does it just mean that returns are going to come down on average?
So numerically, there's a lot of businesses which are within scope. So if you think about UK public market, there's 1,000, maybe 1,200 public companies. In terms of what private equity could address, and it's a big market, so tip to tip, there's a lot of different businesses, it's maybe 20x that. So it's just obvious. The supply of private businesses is way more than the supply of public ones. So you're fishing in an enormous tank, basically. And I mean, they're clearly not all relevant or addressable or you would choose to, but there's certainly no shortage of supply. If you look at the M&A statistics, so private equity's share of M&A activity is about 15%. So it's not zero and it's not 50. And so could it grow? Yeah, I think it probably could. And you'll see that happening. Indeed, you've seen that happening already because the relative share of M&A for private markets or private equity has grown over the last 10 years. But if you look at other markets, it's higher than it would be in the UK. So it still feels like there's a ways to go. What is interesting around it as well is the way that the really good private equity firms actually operate to this extent that they don't wait for deals to prop up. One of the best private equity firms in the world, the guy that runs it said this to me a few years ago now. He said, we don't do deals anymore. What we do is we figure out areas where we think we want to be an investor. And then we figure out every company that's in that area. And then we figure out which companies we would want to own in that area. And then we figure out everything about those companies. And then we wait. And if an opportunity arises, we're in. And we just run faster with more conviction. And we convert those into the deals that we want to do. And that means they need a big organization. So private equity firms are multi-hundreds of people at scale because they're using all this capability to try and solve that. So it would be completely the wrong thing to think that private equity business gets for sale sign stuck on the door and a private equity army rumbles into town and highest price wins. Those days are gone.
When we talk about the UK equity market and how unloved and undervalued and all the rest of it is, we have started to see some M&A, but we haven't seen a huge amount from private equity. But that would seem to fit into the category of those opportunities that you were talking about. So if we don't get them, does that mean that we just don't have enough good businesses in the listed space? Or would you expect to see more deals coming up in the next year or so?
I think there will be for sure, but the private equity world is certainly for the larger pools of capital, the big names, the household names of private equity, they're operating multinationally. So they have zero need to do anything in the UK. Their rule is nothing but the best is good enough. And if it's in Milan or Manchester, they don't care. They're just focused on the what, not the where. And so insofar as they're really attractive UK assets that fit their model and what they're trying to achieve, they'll go after them, but there's no imperative. And I think the interesting thing around it is that if you think about public markets, so say mid 250 and above, so that's say £1 billion of market cap, so say something of that order, say it's 500 million, say it's less than that. That is the purview of the big private equity firms, not the small ones. So private equity firms write checks or do individual deals down to say 100 or 200 million of enterprise value, which is we're right in the bottom of the small cap at that point. The bigger companies, quoted companies in the UK that are sort of mid 250 and above, they're not being targeted by UK targeting private equity firms. They're being targeted by international, pan-European or global private equity firms, and they have no imperative to do anything in the UK. And in fact, they generally haven't done a great deal in the UK. So it doesn't mean that these, if you like, fallen angels in the UK are going to get bought by private equity, because there's just a massive set of options they've got out there. And if it doesn't work, they'll just go somewhere else.
So would that make you rather pessimistic about the outlook for the listed London market?
Well, I think it feels like it's an undervalued market, and I think commentators have made that point. But I think in terms of will private equity be looking to target lots and lots of these assets to buy them, then probably not. I think they screen all the time for opportunities, and it's either the whole business or it's a division or it's, it doesn't have to be the whole asset. But I mean, they're screening all the time to see what fits our lens and our radar for what we should be targeting and what we can do with it and what value we can create. But then the way that these firms work is that it's just the best idea that wins. So the deal team that operates and running around in the UK is going to report into the centre, and the centre is just going to look at everything on its merits and go, do we want to push this one or do we want to push one in Germany? They don't really mind where.
But they might be somewhat constrained a little bit at the moment by the fact that the industry's been contracting a little bit. Anyway, let's move on to HgCapital, which is a very interesting topic. One of the best performing, depending on which period you measure it from, if not the best performing investment trust in the UK. You mentioned the difficulties that private equity sometimes have by having time-limited partnerships. Do you think the fact that listed private equity on the whole has an unlimited life, is that a structural advantage for a listed private equity trust before we come on to the disadvantages?
Well, limited partnerships go a long time. So I've been to a few 21st birthday parties. So they're pretty long life, but they're not infinite life. The listed model, I mean, I think what's great about it is the participation model. So a massive topic in private markets is how to address the individual rather than the institution. And there's a huge effort going into this and lots of different structures being created. Many of them are effectively private market mutual funds or OICs, the private market OICs. But they're targeting quite big individual investments. So £25,000 and up, basically, which is way different to 3 million, which is what it used to be for a limited partnership fund, but it's still significant. And the listed structures are really the only way for the individual to participate. Because effectively, in the listed structure, you've shifted the burden of responsibility and regulatory approval to the vehicle rather than the customer. So one of the challenges the semi-liquid vehicles have got is that it's selling to what's termed a qualified purchaser, which means someone with a certain level of assets and income, etc. And that's what sets the floor for who can invest. Clearly, in a listed exchange, it's the price of a share. So HG's £5 as of about now. And that's access to the whole platform for £5. And that's a unique thing. And actually, there's not many other markets around the world where you can achieve the same kind of exposure. So that's it. I'd say at the underlying investment level, if I ask my students at LBS, like, what's the one line reason for why private equity is a good structure? The answer is it's the only asset class in the world where the insiders make the liquidity decisions. So the whole premise of private equity relative to public is if you're a public market fund manager, you have no idea what the right time to sell is. You just can't have that information at your disposal. You're not allowed to have it. So you can't possibly have it. And in private equity, as an investor, you've outsourced your ability to make a bad liquidity decision to the insider. So you know that they will only sell at the optimal point of value creation because that's how they're incentivized. So effectively what you've got with a listed structure is that you've retained the flexibility to trade your shares on a daily basis, but the underlying investments are being held by the fund managers who are only going to sell them at the optimum point of value creation. And that's what you would want. You wouldn't want to sell them before the optimum point of value creation. Why would you do that? Therefore, you shouldn't, or you wouldn't, and you can't. And that's the beauty of it, right? So that's the two sides to this. So one is it's the way to get exposure to something that you can't get exposure to any other way, really. And then second is you're benefiting from the private equity slightly unfair model where the insiders control all the liquidity decisions.
So then let's talk about what's happened in the last 2 or 3 years. Listed private equity, the majority have often traded at a discount as a matter of course. HgCapital is not one of those. It has traded at a premium periodically. But it too went to a very large discount at the bottom of the market, but certainly in your terms historically, went out to about 25-30%, as I recall. It's now come all the way back in again, whereas many of the other private equity trusts have not. And you're now trading pretty close to par, I think, which is a nice thing to do. So what do you think happened during that period when you went out to a big discount? Was that the market failing? I mean, your performance, as you say, underlying performance of the portfolio companies didn't grow quite as fast last year as in some years, but it has grown pretty well. What's been happening? What happened in the market to send your shares all the way down to a discount?
Yeah, well, it's the sort of conundrum of the whole sector, I suppose. I think in terms of our underlying investments and what was going on, as you noted, nothing really moved. There's a slight sort of variation in the cadence of the sort of net investments and exits, etc., which the board is all over in terms of that's a key risk for us managing that. But the asset level performance underlying was actually very robust. And also, I mean, the thing that everybody jumps on right away is how you get to the numbers for the valuations of the unrealized portfolio. And that is in our case, a hugely granular process that we go through 4 times a year. It's like root canal. And the big challenge that the market gave us was they just didn't believe the numbers. So they just couldn't believe that the valuations were what they were. And I think there are lots of reasons behind that disconnect. But one is you cannot sell a marginal share in any of our companies. You can buy or sell a marginal share in Meta, and the market price is the market price for the marginal share. But we don't have that. Our businesses are valued on the entity level rather than the individual share level. And the way the entities are valued is a pretty robust combination of comparable transactions and M&A comps and public listed entities. And then the thing that we always point to is, I can't remember when we sold an asset below its mark. So wherever we've marked it at, we're typically selling it somewhere north of 20% above. So anyway, I mean, that's us, right? So I think what you saw in the market from our perspective, HG's perspective, was the market looked at what we did, which is sort of software broadly, looked at what was happening to software companies without really making a great distinction as to what they are, saw massive multiple compression in certain kinds of software companies, particularly unprofitable software companies, which we don't do, and down comes the share price. And then as time passes out, what you see is actually the performance of the businesses that we own, and indeed the cycle of our underlying investments around what the capital we're able to send back and the prices we're sending it back at and the premiums we're sending it back at, all sort of becomes validating. And then frankly, HG did a great job, continues to do a great job in positioning the company with investors and saying, this is who we are, this is what we do. We do the world's most boring software. We do the kind of software you can never turn off. None of it is discretionary. All of it is basically fundamental to business process. And so if you want your business to run, you need to have this. And once you've got it, you're not taking it out. It's like too much pain. And it's all profitable and, rules of 40, high profitability businesses, etc. And that recovers. Now, I think what others may find with other platforms, there's two things that are sort of obvious issues. One is we are a direct manager. So everything that we invest in is through one single private equity firm, HG, who happen to be one of the preeminent ones. If you're a multi-manager, then you have another set of challenges. So one is with one single manager, we can manage our balance sheet in a way that is challenging for a multi-manager to manage because we fundamentally know what's happening when and can optimize around it. And obviously multi-manager, you have an extra layer in the middle and therefore you lose visibility on that, which means you have to be more conservative. And then second, clearly there's an extra layer of cost, which we don't suffer. So I think all these factors are certainly behind the story of what happened to HG and what others have seen and that gets us to where we are today.
And as a board, when you saw what happened to the discount, what was your reaction to that? We've seen what happened at Pantheon, for example, and the steps that they took. What has been your approach to that? Is it something that worries you, the discount being as wide as that?
Yeah, definitely does. What we decided to do as a group was to upgrade and refine the policy. So the way we think about it is we keep an eye on the discount because we're there to look after the shareholders and that matters to them. So it matters to us. So the way we set it up is it's now a much more thoughtful process. It used to be it wasn't ad hoc, but it wasn't so structured. And it has 2 trigger levels and it has absolute and relative valuation points that determine the triggers. And the broker looks after this for us. And the broker's job is to alert the board if we break 2 triggers. And that can be a time trigger or an absolute quantum trigger. And then that forces a conversation. So then the group meets and says, okay, this is where we are. This is what's happened with the triggers. And this is the environment that we're operating within. What do we want to do? What's our capacity to allocate capital? What are the consequences of allocating it? And what's our decision? So, for example, a rough rule of thumb, every pound that we buy back costs us £3 of future net asset value. So that's a pretty extreme penalty for doing something today. So we really need to believe that we'd passed the point where we felt comfortable with where that short-term volatility had taken us to, and that the long-term consequences were overweighed by the short-term imperative. And we've met several times and we've acted once, to give you a sense of it. So it works, but it's always a choice. It's always a choice because we're thinking about, if we use capital, when we put this in the ARA this year, we have what we do with buybacks, what we do with the single biggest driver of future NAV growth in the company is commitments to the HG structures. So there's always what capacity have we got in cash in terms of buybacks? What do we think of our future capacity in terms of allocating to the vehicles? How do we think about dividends? And then we have the capital structure of the company, the debt facility that sits within the balance sheet, and how we try and optimize that. And literally every board meeting, there's some conversation around that, because the only thing we know with a single point estimate is going to be wrong. So we're continually trying to think through, where are we, where were we, where are we going, what could happen differently? Because if HG has a new deal, a new investment, we just announced one this week called audit boards. So if audit board, for example, on the way in or an exit that shifts 6 months for whatever reason, that's 300 million of NAV that's moving in that model. So that it is a continual process to try and make sure that we're optimizing. But the good news is, because it's HG and because it's one manager, we do know what's happening with great clarity, but it does move around. And indeed, it moved last year. So last year, we'd actually saw a very successful year for exit activity towards the end of the year. It didn't look like that at the beginning of the year. So that was quite a difference to where we originally set out. So as we're going through the beginning of 2023, we're actually in a very different body position around what we think we're going to have to do to manage the liquidity needs and feed the monster relative to what we were in at the end of the year. And that's part of the challenge of it all.
But you don't have a specific target then. It's not like an absolute target you have. It's always couched in some form of relative terms. Is that right? Or is there actually some sort of...
And you can't tell anybody what it is, because as soon as you tell someone what it is, they'll arbitrage against it and mess things up for you. So there are absolute and relative trigger points in different timeframes. So I think it's 1 month and 3 months that we've set up with the broker, and that's what they report to us, whether we've gone through 2 of them. And then we meet and then we decide.
Right. But obviously, since last year, the share price has performed very strongly. The discounts come back in and you've gone to an all-time high, the shares. So presumably you're pretty happy where you are at the moment. Does that mean you've got more freedom to invest more, to commit more than you did? You didn't commit a huge amount last year, I think, compared to previous years. So does that mean you'll be ramping that up this year? I think you have hinted that you will be doing that.
Well, we're tied to the hip with HG. So if HG have a significant period of new investment, then so do we, because we're effectively 10% of everything they do. So there was one of the fund families was a bit less active last year, the one in the middle, Genesis. The other 2 were actually doing things. This year, I think we'll be busier, because it was definitely a bit of a low point last year. This year we'll be busier. And also because of the cash profiling that we've got, one of the things we try and do to sort of push costs down further is we invest in the partnerships with HG, but we also have an allocation directly to the deals that they do outside of the funds, and we don't pay fees on those co-investments, as they're called. HG manages all this for us, but that's going to go up this year. The relative share of that bucket is going to rise, because we had said an aspiration is somewhere between 10 and 15% of NAV in that bucket, and it's currently high single digits, but I'm reasonably confident that that will rise. So I think you'll see more activity. And indeed, we upsized our revolving credit line because we felt like we were going to be going into it. Obviously, that's one of the reasons for having it. And we didn't really get there because of the accelerated liquidity that we benefited from at the end of the year. But I would be reasonably confident that we'll be heading into that revolving credit line as deal activity picks up, which is what it was planned to do. So nothing to worry about, but it will be a function of increased exposure.
So just looking at the focus of your business, which is, as you say, around boring software mostly, but a nice business to have, nothing like a boring business that brings in cash every year on a renewable basis. There's still plenty of growth there, basically. There's going to be no change in strategy. That's your area, your main area, and that's still churning out sufficiently good opportunities for the next 2 or 3 years. Is that right? I'm putting words in your mouth.
Yeah, no, but fair. So one of the things that we took a look at when I took over the chair was we said, okay, let's stop and just reset and look again and think through, because the company had this benefit of this really strong record of returns. And the thing that we were focusing on, and I was particularly focused on, is if we have a future ambition, will what got us here get us there? Right? We've had this amazing run. Trees don't grow to the sky. How long can this keep going for? So we spent quite a long time looking at this to try and understand how we thought about the model. And actually, the interesting thing with HG as an entity has 2 broadly similar peer institutions in America. One's called Vista, and the other's called Thoma Bravo. and they were considerably bigger than HG. And actually, when you looked at the performance they've been able to achieve at a greater scale, it was very consistent with what we'd seen. So the feedback from HG was actually, in some ways, very heartening, which is we're changing nothing. We have a very clear model of what we do, an execution framework, a real focus. And they were saying to us, we feel like it works at scale, and therefore, it'll evolve, but fundamentally it will stay the same. And then we were able to look at the analogs over in the US and go, well, actually, that does appear to hold some truth, because other people have done this and been able to do it at scale as well. So that led us to believe actually that broadly just keeping going was the right path to follow. And obviously things to check along the way, but not to expect any big strategic pivots in any shape or form, and there won't be any. HG are absolutely inked into what they're going to be doing, which is great. And then we're just going to monitor how they're following that path. So I think what you'll see is very much more of the same. You'll probably see, and you have seen over the last 5 or 6 years, there's more global focus to what we do. So there's more portfolio. The last big business that was announced, Audit Board, is an American company. I think that will continue to be a feature. HG's got a lot of people in the States now, and you'll see more transatlantic businesses that appear in the portfolio. So, if as opposed to being 90-10 Europe, America, we might end up at 70-30, something like that, but nothing to worry about. It's the same model, and that's about the only change to expect.
Okay, so I think we'll leave it there, if that's okay. I'm conscious we talked a lot about the private equity world and not a lot specifically about HG. Is there any other particular points you wanted to stress?
I think it is really just keeping the hammer down. And I think as well, the board are in the right way, a little bit paranoid. So we're a bit paranoid around, will it all keep working? And are we managing the risks? Because we're quite aligned to HG, but we're not the same. And we're an independent company, and we need to behave like that. And I think that's what we are set out to do. And I think we've been really lucky with some board recruitment in the HG public company. We've got some great board talent, which I think is super exciting for the long term. So I think we'll be maintaining that level of productive paranoia and sticking to our guns.
I suppose there are some risks out there. We all know that there's geopolitical risk, there's issues around debt, certainly in the government space. What would be the thing that would be the most worrisome for you?
Cyber. We're 50 software companies. Because geopolitical, frankly, if it really goes wrong, nothing matters. So we watch that, but it doesn't really affect our operations. It's just more of a threat to us all in a much broader sense. But cyber is definitely the obvious one, because we have a lot of cloud businesses. It's all basically software. And that's what we're very focused on, making sure that we're as protected as we can be. And HG are as well. They get that that's a risk to them, an existential threat. And so they spend a lot of time and effort trying to mitigate it, and that's as much as you can hope for, really. And fire door all your different assets so that getting through one door doesn't get you any further than the door you got in, and tools like that are really front of mind. But that's the really big one. But capital structures, financial structures, I don't really worry for us. I think, again, if we really end up in a mess on capital structures, we've got much, much bigger problems out there, because I think we've just been going through deal cycles and refinancing and financing assets, and it's all been okay. So short of a big exogenous event that really hits everything much more broadly, then I think we're okay on that one. But the paranoia level is very real. So we do go through this certainly every 6 months, and there's a check-in the middle to make sure that we're not missing something.
So that was Jim Strang, the chairman of HgCapital Trust, one of the largest trusts in the UK listed market.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited, and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note, these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.